Welcome to the third episode of this market timing and stock picking YouTube course. In this episode, I'm going to show you why buy and hold is most dangerous than most people think. Usually, buy and hold is presented as a safe, simple, and almost foolproof option for most investors. But simplicity is not the same as safety. Today, I want to talk about the risk that almost never make it into the marketing brochures. The first one is the drawdown problem. Most investors underestimate how psychologically and financially destructive deep drawdowns are. It is one thing to look at a chart and see that in 2002 or 2008, there was a huge 50%, 55% drawdown. And then, of course, in hindsight, you see that the market recovered, and then you say to yourself, well, I would have survived because I know that eventually the market always recovers. So, okay, it was a 55% drawdown or maybe an 80% drawdown in the Nasdaq, but I will have a strong gut and I will survive. But another different thing is in real time, when you have real money on the line. I can tell you because I've been trading the market for over 35 years. So once you have real money on the line and you have, for instance, $100,000 in your broker account and it goes down to $30,000, a 70% drawdown, I can tell you that you will have sleepless nights and it will really destroy you psychologically. And eventually you will throw in the towel at the worst possible moment, which will be the market bottom. So one thing is to look at charts and buy the typical mantra, oh, the stock market eventually recovers, you just have to have time in the market. And the other thing is to live through real drawdowns with real money in your broker account. So this is why in real life you need to protect against drawdowns, because we are very brave when it comes to paper trading or when looking at past charts. But in real life, we are all cowards, me included. I became a successful market timing and stock picker because I am very aware of my weaknesses, and I know that I will panic if I have a 55% drawdown. So since I know that I will panic, I know very well what I have to do not to be psychologically devastated by drawdowns. The second issue with drawdowns is what I call the math of withdrawals. You look again at the chart of the S&P 500, you see there was a drawdown, but you see, oh look, it recovered and eventually it made higher highs. Okay, that is beautiful, but in real life, maybe you need to tap on your savings. And in real life, you don't have the benefit of maybe waiting 20 years or 25 years for the stock market to break even in inflation-adjusted terms after the drawdown. Moreover, what if you have to pay the school of your children or the tuition of your daughter's university, and you have to tap into your brokerage account at the worst possible moment? What if your stock account is 50% down and you need an additional $10,000, so you dig deeper, you draw down from 50 to 60%? Then the time to recover grows exponentially. So in real life, you will need your money. And even if you say, no, I won't need my money, is money that can sit idle for 25 years, you never know what the future has in store for us. So in other words, real trading is not like looking at a chart, an equity chart. In real life, most probably you will need to use your money at the most opportune time. And the third thing you must know is that maybe this time is not going to be a normal bear market, because many people say, well, look, horrible bear markets were the 1930s when the stock market dropped by 85%, and it took, in inflation-adjusted terms, it took, I think, until 1955 to recover. But most people say, well, this was in the past, this will never happen in the future. But I'm sorry, it happened more than once, because from 1966 to 1980, the stock market went nowhere. It was maybe not the 80% drawdown, it had a drawdown of 50%, but in inflation-adjusted terms, the stock market really had a huge drawdown. So wealth was depleted. And if you had to tap once again on your savings during these huge drawdowns in the 70s, then your wealth was totally destroyed. And you will say, well, this was another exception. Well, I will give you another example. The decade from 2000 to 2010 was another lost decade. We had two huge bear markets. We had a huge bear market from 2000 to 2002, where the Nasdaq fell more than 80% and the S&P dropped by almost 50. And then we had again, from 2008 to 2009, another huge bear market when the S&P plunged by 55%. And you will say, yeah, but eventually the stock market recovered. Yes, eventually, but you need protection against such drawdowns. And this is why you need market timing. So, taking comfort in the last 10 years of rising markets and saying that, well, this will never happen again is really dangerous. Markets have a habit of punishing investors precisely at the time when they expect that everything is going to be fine and dandy, that the market is going to have a smooth upward sailing. In real life, nobody knows when a huge drawdown is going to hit. I don't know, you don't know, nobody knows. And if somebody tells you that they know, that they can predict, this is false. I tell you, you don't need to predict to be successful in the stock market. You need to react, which is a different thing. And market timing is about reacting, determining when the trend is going to change or has changed, and then you adapt, you react, you don't need to predict. So this is why market timing matters. Market timing is like an insurance against the destructive power of drawdowns. But unlike a traditional insurance, market timing, it actually pays you to pay the insurance because you get outperformance and drawdown reduction. So I think it's the only insurance that pays you to hold it. This makes market timing something exceptional. You have an insurance, you get more or less a 50% drawdown reduction, but instead of paying money to get your 50% drawdown reduction, you still manage to get, when you time the indexes, an additional 3% outperformance. So this is the positive price of the market timing insurance. And finally, fourthly, there is the typical argument that says eventually the stock market always recovers, and okay, if you have a 30 years time horizon, everything will be fine because the US stock market is always the best stock market in the world, and this is true. But you have to be aware, and maybe I know that because I was not born in the USA, that you Americans have had the best stock market and the best economy in the world. You won the First World War, you won the Second World War. Furthermore, you have a great economy. You really encourage capitalism, free markets, the enterprising spirit, and this results in a vibrant stock market. In other words, your companies manage to increase earnings at such extraordinary pace that no European country can. Furthermore, in the rest of the world, there are countries that have lost wars, they've had horrible economic meltdowns, hyperinflations like Germany, deflations, you name it. And the USA, thanks to its ingenuity and its economic system, and also because it was on the right side of history, has avoided all these destructive forces that unleashed in other countries. But what if one day the USA stops being the USA? I don't want this to be, because my fortunes are tied to the fortunes of the USA, because I deeply believe that the USA is still the less dirty shirt in the laundry basket, because it has its problems, its issues. But if you compare the USA, at least in economic performance, to other countries, it's still a powerhouse, and it has the ability to reinvent itself. Look now with AI, many say, oh, AI is not going to work, or they are investing too much money, whatever. But the USA is really a master in creative destruction. So let's imagine one day the USA adopts the economic policies of Europe or of other countries that really hinder free enterprise. Do you think the stock market is going to be so resilient as it has been in the past? No, we don't know the future. And this is why we need market timing. What if the USA has a repeat of the 1930s and we get another 80% drawdown? Or what if the USA, I don't know, gets horrible economic policies that it really destroys the economy? You need market timing, because market timing will tell you to exit the US stock market. So you really need it. And sometimes US citizens are too relaxed, and I can understand it, because they have always been isolated from real hardship. But ask a European, ask a Chinese, and the rest of the world has experienced total meltdowns of their economy. I don't want this to happen to the USA. I don't expect it to happen, but hope is not an investing strategy. The best thing is to protect yourself, and this is done through market timing.